Okay, let's just jump right in. We're going way back to 1983, but, this isn't some dusty old history lesson. We're about to unpack one of the most important documents in modern business, Warren Buffett's Owner's Manual. And really, it's not just an annual letter. Think of it more like a constitution, a timeless guide for how to think about investing, business, and what things are actually worth.
And this right here, honestly, this one sentence is the key. It unlocks everything else we're going to talk about. It's the core idea, right? When you buy a share of Berkshire Hathaway, you're not just some stockholder on a list. No, you're an owner, a partner. And that simple shift in perspective, it changes the entire game.
So here's what we're going to do in this explainer. We're going to break down the core philosophy from this foundational document. We're going to turn his principles into real, actionable wisdom. And the best way to do that, we'll look at the exact stories and ideas Buffett himself used to teach his partners. Sound good? Let's get into it.
All right, let's dig into the core principles of this partnership. So what are these core beliefs? Well, in the manual, Buffett lays out what he calls a catechism for his owner partners. And just to be clear, this isn't some dry list of business rules. No, this is way deeper. It's a philosophy, a whole way of thinking about how to operate. Okay, these 4 points, they really get right to the heart of it all. First, you got to think like an owner, not just someone renting a stock for a few months. Second, it's all about maximizing the value per share, not just making the company bigger for the sake of being big. Huge difference. Then there's this really critical point. Accounting numbers, yeah, they can be super misleading sometimes. But the bedrock of it all is that last one. Only do with your partner's money what you would do with your very own. It all comes down to trust.
And this quote, "We eat our own cooking." I mean, it's just a perfect folksy way to say it, right? It means their interests are completely aligned with their partners. The directors at Berkshire, they have most of their own family's net worth tied up in the company. So they only win if you, the shareholder, win. Simple as that. It's the ultimate skin in the game.
Okay, so that's the theory. It sounds great on paper, but what does it actually look like in the real world? Well, Buffett gives us the perfect example. It's the story of how he bought the Nebraska Furniture Mart, a deal he said was the high point of his entire year in 1983. So let's meet the hero of this story, Rose Blumkin, better known as Mrs. B. Her story is just incredible. She escapes Russia, lands in America with basically nothing, just pure grit. She doesn't speak a word of English, and she actually learned the language by listening to her daughter's school lessons. But man, did she have a dream. And what did she start with? This, $500. That's it. Which is $500 she decided she was going to take on the entire furniture establishment in Omaha. Just stop and think about that for a second. $500 to build what would become a massive retail empire. It's just wild.
And you can bet the established competitors did everything they could to shut her down. They were pressuring manufacturers, telling them, "Don't you dare sell to her." But Mrs. B, she was just relentless. And get this, when she ran out of money, she sold her own furniture from her own house to make sure she paid her creditors on time. I mean, who does that? That's a level of integrity that's almost off the charts. Which brings us to Buffett's ultimate compliment. He said he'd rather rustle grizzlies than compete with her. He saw a business that was just brutally effective. And why? Because it was built on one simple, powerful idea. Give your customers insane value, and the economics for the owners will take care of themselves. Mrs. B wasn't just smart, she was profoundly wise. Okay, so it's obvious a business like Mrs. B's is incredibly valuable. But how do you actually measure that? How does Buffett keep score? Well, this brings us to a really important distinction he makes between two very different kinds of value. On one hand, you've got book value. Think of this as the accounting number. It's all about what's been put into a business, the historical cost. But then, on the other hand, you have intrinsic value. This isn't an accounting number. It's an economic idea. It's an estimate of all the cash you can take out of a business over its entire life. So the key takeaway, book value looks backwards. Intrinsic value looks forwards. And Buffett, being Buffett, has this absolutely brilliant analogy to make it crystal clear. Imagine you have two kids. You send them both to college, and you spend the exact same amount of money on their education. So the financial input, the book value, is identical. But their future earning power, their intrinsic value, well, that could be wildly different, right? It's the exact same thing with businesses. So you might be asking, why can intrinsic value be so much higher than book value? And a huge part of the answer lies in this powerful, but often pretty misunderstood concept called economic goodwill. And what's so cool about this is that Buffett is totally open about how his own thinking had to evolve. He admits that he was taught, the old school way. Look for businesses with lots of tangible stuff, factories, equipment, things you can touch. But his own experience taught him that the real treasures were businesses with powerful, intangible assets, things like a rock-solid brand reputation. The See's Candies deal is the perfect way to understand this. So check this out. Back in '72, Berkshire buys See's for $25 million. But the company only had $8 million in tangible assets. So what was that extra $17 million for? That was the goodwill, the price they paid for the incredible power of the See's Candies brand. Now, accounting rules are weird. They make you slowly write down that goodwill on paper. But in the real world, the economic goodwill of See's has just grown and grown. Why? Because when you have a brand people love, you can raise prices a little bit each year. And you don't have to pour a bunch of new money into the business to do it. It's an amazing economic engine.
And that right there brings us to this fantastic line from Buffett. In a world where prices are always going up, a business with a powerful brand that doesn't need tons of new capital investment, it's just an absolute economic machine. Its value just keeps compounding. It really is the gift that keeps on giving.
Okay, let's move on to our final section. We're going to tackle a question that Buffett gets asked constantly. And his answer, well, it reveals everything about what he thinks the stock market should and shouldn't be. The question is pretty straightforward, right? Why doesn't Berkshire Hathaway ever split its stock? I mean, the price is so high, why not make it more affordable so more people can buy in? It sounds like a totally reasonable question. But Buffett's answer is a hard no. And the reason is fascinating. He's not trying to attract everyone. He wants to attract high-quality shareholders, people who think like owners and are focused on the long-term value of the business, not the day-to-day squiggles of the stock price. That high price, it actually acts as a filter. It attracts serious, long-term partners, and frankly, keeps away the people who just want to treat the market like a casino. Because in his mind, all that constant, hyperactive trading, it doesn't create any value. He calls it the pickpocket of enterprise. Think about it. Every single trade has costs, right? Commissions, fees, they all chip away and drain value from the actual business owners. He says the house always does well in a casino. But all that activity is almost always bad for the actual players, the owners. And so this whole letter from all the way back in 1983 really leaves us with a fundamental question, a question we should all be asking ourselves. Are you an investor, someone who's focused on the business itself, on its long-term intrinsic value? Or are you a speculator, someone just changing chairs in a very expensive game that doesn't really create anything? It's a powerful thought to end on, isn't it?